All right, so now we're talking about the second part of this chapter, which is deductions from AGI. And again, it's from AGI deductions, you either take the standard deduction or if it's higher, you take itemized deductions. And so this is the stuff on page 4, chapter 4, page 26. And so let's see. And so you take the higher of the standard deduction or itemized deductions. Whichever's higher, that's the one you take. So the standard deduction's pretty simple. You just take standard deduction for each member in the household and kind of go from there. Let's see. So the first thing they talk about is medical expenses, and this really is meant for people with pretty high medical expenses. You can only deduct or itemize medical expenses after the first 10% of those medical expenses, first of all. So you have to have some pretty high medical bills in order to itemize. In other words, if you had $75,000 worth of medical that was uninsured, of course, and that you paid, you'd have to deduct 10% of that, $7,500, and you can't itemize that 10%, but anything over that is subject to itemization, as long as it meets the requirements of a valid medical expense. So that's kind of how that works. Most people are insured, so, but you know, if you're on like Obamacare or something, you got some pretty high deductibles, you might run into a situation where, or if you're uninsured, you know, you've got some pretty high medical expenses, then you would be able to do this. In reality, this doesn't apply to very many people because a majority of people are covered by some medical insurance. But anyway, it's worth talking about. And so a taxpayer can deduct medical expenses incurred to treat themselves, their spouse, and their qualifying dependents. Qualifying medical expenses include unreimbursed payments for care, for prevention, for diagnosis or cure of an injury, a disease, or something called bodily function. Now, you know, that's a lot right there. Most people understand the care, prevention, diagnosis, or cure of injury and disease. What is bodily function? Well, probably the best example I can give there is your eyes. If you're like me, you don't have perfect eyesight, and so you need some assistance in seeing things, then certainly if I go to an optometrist, they're going to diagnose and maybe not cure, but at least assist in helping me see. So the bodily function there is my eyesight. And so what does this include? Well, it includes doctor's visits, visits to physician's assistant, prescriptions, glasses, all those things. Note that it doesn't cover over-the-counter type of medications. Tylenol, Advil, Sudafed, Benadryl. You can't deduct those expenses. Note that it covers transportation. And you can, for transportation, you can deduct actual mileage, actual expenses, or you can deduct a standard mileage allowance. Again, this is 23 cents per mile in 2015. Note that it covers long-term care facilities. And, well, it certainly is going to cover hospital visits, but let's say you have a long-term issue, medical issue. And so you have to go into this facility that provides you with round-the-clock care. Certainly that's covered as well. We'll talk a little bit more about that here in a minute. And health insurance premiums, if as long as that health insurance premium wasn't previously deducted for AGI by a self-employed taxpayer. So hospitals, I think everybody understands that that would be a deductible cost. Long-term care facilities. And so for those, you're getting kind of a combination of several things. You may be getting around-the-clock care for your medical condition, but you're also getting a roof over your head and food in your belly. So, because of that, it could look like, well, they're just choosing to live here for the food and the roof over their head. You have to meet a little more stringent requirements. So in the case of long-term care facilities, nursing homes, they're deductible only when the principal purpose for the stay is medical care rather than convenience. So it's got to be something that is pretty serious and requires, the condition has to be serious and requires round-the-clock treatment. Not, the excuse can't just be, well, I wanted to be closer to where they can take care of me and I can't take care of myself, that sort of thing. Now note the limitation here. The general rule is that your medical expenses paid during the year, first of all, that's an important thing. You can't just have a bill for the year and deduct it. You actually have to pay it. Okay, so that's kind of important to know. And so the deduction limitation is that the amount of unreimbursed qualifying medical expenses paid during the year is reduced by 10% of the taxpayer's AGI. Okay, so let's say you have $75,000 of AGI, and your medical expenses are, I don't know, $50,000. Well, you've got to reduce that $50,000 by 10% of AGI, so that would be $7,500. And so you could only deduct $50,000 minus $7,500, or $42,500, as an itemized deduction for medical expenses. Again, it doesn't happen very often because most people are covered by insurance and don't come anywhere close to having enough medical expenses that are going to reach above 10% of AGI. I mean, if you have $75,000 of AGI and you only have $5,000 of unreimbursed medical, well, you don't even reach the 10% of AGI level in order to itemize any of that $5,000, because it's not in excess of 10% of AGI. So it's got to be in excess of 10% of AGI. For taxpayers that are, or a spouse that are 65 or older, the limitation is 7.5% of the taxpayer's AGI. Going back, just back to medical expenses. What's not covered here besides over-the-counter stuff? What about plastic surgery? Let's say, you know, I'm getting old and, you know, I need a little nip and tuck here and there to make me look younger. And that's important in my business because I got to look good on these online lectures. Can I deduct the cost of that plastic surgery? And the answer is no, I can't, because again, that's not something that's for the care, prevention, diagnosis, or cure of injury, disease, or bodily function. Well, what if I have some horrifying facial deformity caused by some sort of condition, disease? Could my plastic surgery to fix the problem be deductible? And the answer is yes, it can. Now, there are some novel cases out there if you want to do some research. I mean, not to get too PG-13, but I mean, you'll find some cases where strippers have actually been allowed to deduct the cost of breast implants because I guess that's important to have those things in their job. But those are kind of outliers. Certainly they had to go to court and get the court to agree with them. But for the most part, I think you get the gist that it's you can't just have elective surgery just because you think you need it. It's got to be, some sort of injury, disease, or bodily function in order to qualify. What about my doctor? I have a real stressful job. I used to. And I work 80 to 100 hours a week, and my blood pressure is just going through the ceiling. My stress level is just off the charts. And my doctor says, you need to take time away and take a trip around the world. Just take a cruise around the world. I do, and I come back 30 days later and I feel fantastic. I'm a new man. Can I deduct the cost of that cruise? And the answer is no, I can't. Although I'm sure it's been tried. Well, what if I have like pretty bad rheumatoid arthritis and the doctor prescribes that I construct a pool in my backyard? I don't know if they do that up here, but anyway, kind of go with it. Is the cost of building the pool deductible? And the answer is yes, it is. Because it is, I guess, for the care or cure, or at least easing the situation of a disease. Well, what if I have an injury and because of my injury, I'm now paraplegic. I'm in a wheelchair and my house just isn't set up for wheelchairs. I've got to have some railings. I've got to have the kitchen counter and bathroom counter lowered where I can get to them. Got to have the hallway widened, things like that. What do I do there? Are those expenses deductible? And the answer is yes, it is. So is this a little hit and miss? Yeah, absolutely. I mean, again, there's some outlier cases. The stripper case certainly is. I think there's one about derriere implants too, so it's just really weird. There's some very interesting cases. If you go out to Google, U.S. tax court cases or something like that, you'll find some real interesting arguments. Some are winners, most aren't. All right, so I just kind of wanted to elaborate on that. Taxes. Individuals may deduct itemized deductions for the following taxes: state, local, and foreign income taxes. And so if you pay state and local taxes, well, notice what it doesn't include. It doesn't include federal taxes. I mean, that would be kind of circular, wouldn't it? If you're, filing a federal tax form and you get to deduct federal taxes paid, that's not going to work. Real estate taxes on property held for personal or investment purposes. So You know, if you own a home and you pay real estate taxes, property taxes, ad valorem taxes, you get to deduct the cost of those ad valorem taxes that you pay. Personal property taxes that are assessed on the value of the specific property, that's also an ad valorem tax as well. Sales tax deductions. Sales and local sales taxes, or excuse me, state and local sales taxes can be deducted in lieu of state and local income taxes. Now it says it's scheduled to expire after 2014, but I bet you, and I haven't checked this, but I bet you that that's been extended through 2015. But anyway, what's the catch here? Well, you definitely have to keep a lot more records. Of course, here in Oregon, we don't have sales taxes, so it's not even an issue. Interest. And so you have two itemized deductions for interest expense here. You get to deduct investment interest, but it's limited to the taxpayer's net investment income. And then any investment interest in excess of the net investment income limitation carries forward to the subsequent year. So if you borrow money to invest in some sort of investment and you pay interest on that debt related to the investment, you get to deduct that to the extent of net investment income, and any excess in the interest is carried forward to the next year. The big one, and really in most instances, the one that determines whether or not a taxpayer itemizes or uses the standard deduction, is two of the following. Home mortgage interest. That's usually the biggie that moves a taxpayer from standard deduction to itemized deduction. And so the interest is limited to the interest paid on acquisition indebtedness of $1 million. Okay? And so what is acquisition indebtedness? It's any debt secured by a qualified residence that is incurred in acquiring, constructing, or substantially improving the residence. In most instances, what it is you get a loan on a home and you got to pay that loan back, principal and interest. Well, the interest you pay is deductible, at least on the interest that applies to indebtedness up to $1 million. For most people, that's not a problem. They're way under the $1 million indebtedness cap, and so all the interest they pay is deductible, as long as it's more than all their, along with all their other itemized things. But I can tell you, in most instances, this is the biggest itemized deduction for most people who own a home. Now note, on top of the interest paid on acquisition and indebtedness up to $1 million, taxpayers can also deduct interest on a home equity debt of up to $100,000. Now notice here, you can basically deduct interest on total debt on a principal residence up to $1,100,000. Now, they define home equity indebtedness as any other debt secured by the taxpayer's qualified residence. Now note, there's two limits here on the mortgage interest deduction. The taxpayer may only deduct mortgage interest on up to $1 million of acquisition indebtedness, and the amount of qualified home equity indebtedness is limited to the lesser of the fair market value of the qualified residence in excess of the acquisition debt related to the residence. So what they're talking about there is how much equity do you have in the home? I mean, if you've got $100,000 home equity loan and you only have $25,000 of equity in the home. In other words, you've got a $200,000 home and, well, you owe $200,000 on it, and it's worth $225,000, then you're only going to be able to deduct interest on $25,000 of indebtedness. But let's say you have a home that you bought or that you owe $200,000 on, and it's now fair market value of $300,000, then interest on the whole $100,000 is deductible. Now, note here, this home equity debt. Now, you would think that they would require that the money from the home equity loan be used for repair or improvement to the principal residence, but that's not true. As long as you get a home equity loan, you know, a loan that's secured by the equity in the home, it matters not what you use those funds for. So one thing we'll talk about in the future is, well, what about interest on a personal loan? Is that deductible? And the answer is no, it's not. Well, what if I have equity in my home and I want to buy a car and I want to deduct the interest? Well, if you get a car loan, it's not deductible, that the interest you pay on that car loan. But you could get a home equity loan and deduct the interest paid on the home equity loan and use the funds to buy the car. So perfectly legal. It's a good strategy. It's a good tax planning strategy. It's a good way to save money for your clients. All right, charitable contributions, I don't want to spend a lot of time on it because you could just like get lost in the weeds on this. And so the things I want to cover are the following. The contribution of money or property must be made to a qualified charity. Well, how do I find out what's a qualified charity? Well, apparently the federal government, the IRS, Treasury, they put out a list of who are the qualified charities. So if you want to know if a charity is a qualified charity, you go to the list and check it out. Note that qualifying charitable organizations, as a general rule, include organizations that engage in educational, religious, scientific, governmental, and other public activities. And so notice that IRS Publication 78 lists the organizations that the IRS has determined to be qualified charities. So you would go to Publication 78 to find out if it's qualified charity. Note that political and campaign contributions are not considered charitable contributions and are not deductible, even though they arguably indirectly support the government. Now, the amount of the charitable contribution is subject to certain rules. If it's a contribution of cash, they're deductible in the year paid, and that cash includes by check, electronic funds transfer, credit card charges, and payroll deductions. Now note here that there is a 50%, well, there's actually 3 different levels of limitations on charitable contributions, but for contributions of money, you're limited to 50% of AGI. So you have, again, AGI of 75,000, you would be limited to giving 37,500. Well, what if I gave 50,000? What if I, you know, it's kind of hard to believe that a person making 75,000 can just give away 50% of their income, but let's say they inherited a large sum of money. Inheritances are non-taxable, right? And what they want to do is they want to save taxes on their current income. So they turn around and take 50,000 and pay it to a qualified charity. Well, they would be limited to 37,500 in the year they pay it. Well, what happens to the rest? Well, the excess, in my example, 12,500 excess, that's treated as if it were made in the subsequent tax year and is subject to the same AGI limitations in that next year. The excess contribution is carried forward and it can be deducted for the next 5 years, if need be. Certainly, if you use all of it up before then, you know, my example, $12,000 carries forward to the next year and I still make $75,000, well, I'm going to use up all that $12,500 excess contribution in that next year. So, but usually that doesn't become an issue unless you give a lot of money away or you're contributing, let's say a painting that you got that turns out to be a Van Gogh or a Renoir or something like that. Not that I know much about paintings, but just two names I remember. There you would have capital gain property, and not only would you be subject to the 50% rule, but there's some other rules. There's a 30% rule and a 20% rule, depending on the type of charity you have. Again, I don't want to get too deep into this, but they have special rules that apply when you're contributing something other than money. If it's a capital gain property or ordinary income property such as inventory, there are special rules and special limitations, as well as the type of charity you give it to. There's one set of rules, one set of limitations for public charities and private operating foundations, and then there's a separate rule for private non-operating foundations, such as the Bill and whatever her name is, Gates Foundation is considered a private non-operating foundation. It's not a public charity. So that's all I want you to know about that. You don't have to know those special rules for capital gain property or ordinary income property. If you get deep into tax practice, I encourage you to, get the experience, number one, and research this stuff further. But this is a basic course, so just trying to teach you the basics. Let's talk about casualty and theft losses on personal use assets. So this would be your car, a ring, stuff like that. And so the amount of the tax loss from any specific casualty event, this would be casualty or theft, is the lesser of the decline in value of the property caused by the casualty or the taxpayer's basis in the damaged or stolen asset. So it's the lesser of those two. And so a casualty loss is defined as a loss arising from a sudden, unexpected, or unusual event such as a fire, storm, or shipwreck, or loss from theft. And so taxpayers, if they meet the casualty loss definition, may deduct casualty losses in the year the casualty occurs, or in the case of theft, the year the theft is discovered. Sometimes that could be later. Now there's some pretty unusual cases here too. I would suggest that you read on page 25 the trilogy of the rings and see if you can make any sense out of those rulings. These are 3 tax court rulings, and in some cases it seems to be kind of a head scratcher as to why, a court ruled one way and then another court ruled a different way. So anyway, and again, you have to understand, in tax court, there's no jury. So it's the judge who stands in as both the judge and jury, and so they're making the decision. Well, what if I have a loss? Let's say I have pipes that just over time have corroded and suddenly they burst. Is that a sudden, unexpected, or unusual event? And the answer is no. So general wear and tear, a loss that occurs because of general wear and tear, is not going to be a casualty loss. How about a tree that just over time falls on the house and causes damage due to its own weight? Same answer. It's not sudden, unexpected, or unusual. Bottom line is, if you've got that sort of situation going on, plan ahead and act accordingly. Now, just like we've seen with some of these other deductions, you have a floor limitation, and here you have actually two. And so it's got to exceed these two separate floor limitations to qualify as an itemized deduction. And again, all your itemized deductions have to be greater than standard in order to even use itemized deductions. So the first limitation is $100 for each casualty during the year. So you have a casualty of $5,000. It's one casualty. You're going to deduct $100 from the $5,000. And let's say you have two casualties. One's for $5,000, the other's for $2,000. You're going to deduct $100 for the $5,000. You're going to deduct $100 from the $2,000 casualty. So each casualty gets a deduction of $100 right off the bat. And then on top of that, you're going to deduct 10% of AGI off those, well, off both of those casualty losses. And so let's go back to our example of previous example plus current example. You've got 75,000 AGI, and you've got a two casualty losses, one for 5, one for 2. Okay? And you first deduct the 100 from each. So you've got 4,900 plus 1,900. That's going to equal $6,800. And so you combine those casualty losses for the year after deducting the $100 for each casualty, and compare it with 10% of AGI. If it's lower than 10% of AGI, as in our example, it's only $6,800. You don't get to deduct anything. So it's the excess of 10% of the AGI floor after applying the $100 to each. So like they say, in other words, the itemized deduction is the aggregate amount of casualty losses that exceeds 10% of AGI. I would look at example 6-22 and 6-23 for guidance in that area. All right, then you get down to these miscellaneous itemized deductions subject to an AGI floor of 2% of AGI. So you get a little bit of a break. The threshold here is a little lower. It's only 2%. Anything in excess of 2% of AGI, as long as it qualifies under one of these headings, is covered. And so employee business expenses, now these are unreimbursed employee business expenses. Not very many, at least in my experience, if you have a good employer worth working for, they're going to pay your business expenses. But if you have any unreimbursed business expenses, it's covered. Well, what about, this comes up, well, what about my commuting back and forth? Isn't that an employee business expense? And the answer is no. Commuting costs to go to and come back from a job is not considered a employee business expense. Now, what is covered? Well, says that expenses that qualify include those that are appropriate and helpful for the employee's work, such as cost of professional dues. So if my employer doesn't pay for my CPA certification that I pay the state each year, I can deduct that possibly. Investment expenses, I'm not sure why that's in there, and certain other expenses. And so you sum all those miscellaneous deductions. Oh, I got off. Professional dues, uniforms, union dues, subscriptions to publications related to employment. So if you're a CPA and you've got your yearly fee that you have to pay to the state, and you also apply or subscribe to an accounting journal, the cost of those items are covered as long as they are in excess of 2% of AGI, or at least the excess is. Notice that there are several types of employee expenses that are restricted. The cost of job hunting is restricted only to those job hunting expenses that qualify when the job is in the employee's current trade or business. It does not cover the job hunting costs of looking for your first job. Now, that could be two things. You could be graduating from college and getting your first job, looking for your first job, or you could be employed in a different line of work and be looking for a job in a different line of work. Neither of those are qualifying job hunting expenses. What about cost of education? Let's say I'm a CPA, I have a master's in tax, or master's in accounting, BA in accounting, something like that. Let's go back to the master's in tax. And I live in the big city, and there's this couple of schools that have a couple of law schools that have evening programs, and I think it would be of great benefit to me in my job to go back at night and get a law degree, because I apply tax law. I just think it would be fantastic to supplement my education by knowing as much as I can about law. Is that deductible? And is the tuition, the books, fees, and all that, is that deductible? And the answer is no. Well, why not? Well, the answer is it's not deductible if the education qualifies you for a different job. Well, but it helps me in administering the tax law. Well, that may be true, but it also qualifies you to become a lawyer. So, that's the usual circumstance. You'll see people want to go to law school. Why, I don't know, and this comes from someone with 2 law degrees. So, don't go to law school unless you're just doing it for the heck of it. Don't become a lawyer. We have too many of them anyway. What about the cost of an MBA? Well, it kind of depends on what your current position is. If you're in an executive position and you want to enroll in an executive MBA program, more than likely the cost of that is going to be qualifying you as an itemized deduction, miscellaneous itemized deduction. Why? Because it helps you make better decisions in your current job. Well, what if I'm a fairly low-level employee, but I want to get an MBA so that I can improve my position, make me more promotable in the company? Well, probably in that instances, you're going to not be able to deduct those costs, because that qualifies you for a different job, meaning it qualifies you for a job up the chain of command. So, again, probably when you took this course, you didn't realize how mushy this would be. You probably thought everything was black and white. I'm telling you, the tax law is not so much black and white as different shades of gray. Hobby losses. So notice travel and transportation. If it's unreimbursed travel, let's say you go around to various sites as part of your job, different stores or different offices of the company you work for. And let's say you have your main office and then you have all these other branch offices. Certainly the cost to commute to the main office is a commuting expense and not deductible, but certainly the travel from the main office to these other branch offices would be deductible. How often do you see that? Not very often, because most employers reimburse you for it. But notice that if you do have such costs, the standard business mileage rate, you can take actual cost or standard mileage rate, is 57.5 cents per mile. We've seen in some other instances where transportation was only reimbursed at a standard rate of 23.5, I believe it was. The other big item that I want to talk about is hobby losses. Certainly if you're engaged in a business for profit, you're going to be able to deduct those costs. But as I mentioned in our last lecture, sometimes people who become wildly successful in their core business get off into these other ventures, things that they like to do, their passion, their real passion. Again, horse breeding, horse racing, collecting vintage cars, racing cars, things like that. Well, if the activity is primarily for personal enjoyment, it's going to be considered a hobby, and you're going to be limited in how much you're going to be able to deduct as far as the expenses. And usually for those types of activities, believe me, the expenses far outweigh the revenues received from whatever the activity is. And so you usually have losses. And so the question is, can I deduct those losses? Well, again, if the primary motivation of the activity is to gain, to have income, have a net income, meaning excess of revenues over expenses, certainly that's deductible as a trade or business. And if you're self-employed, that would be a Schedule C type thing. But again, if the motivation is personal enjoyment and you have losses from this activity, you're going to be limited in the amount of losses you can deduct. It's subject to this 2% AGI floor, first of all. All these miscellaneous itemized deductions are added up and subject to the 2% of AGI floor limit. And there's another limitation on top of that. And basically, your hobby losses are limited to the amount of revenues that you receive in the hobby activity. Now, the IRS has looked at several factors, and I won't go through them, but they are certainly there on page 29. None of these, at least they say, is necessarily more important than the others, but notice that one of the most important factors is the taxpayer's history of income or loss. And so what they've done is created a presumption that an activity is for profit and thus losses are deductible on Schedule C if they have a profit, if the activity generates a profit for 3 out of the prior 5 years, then that creates a rebuttable presumption that the activity is for profit. And therefore, if you have a loss, it's deductible on Schedule C. You list your revenues, you list your expenses, the loss carries over to Form 1040. If you don't, now notice it's a rebuttable presumption, so I mean the IRS could come in and list some of these other factors to rebut the presumption that it is for profit, but at least it's a presumption. The presumption's out there, and it's the burden to the IRS, on the IRS, to prove that it's not for profit. So that's kind of shifting the burden of proof there to the IRS, which is a good thing because in most instances, taxpayer has the burden of proof on, you know, whether an activity is this or that. So I think that's all you need to know about hobby losses. It's pretty mushy. If you get into that sort of situation, you're going to have to deal with the IRS on debating whether or not this is a for-profit business, trader business, or just a hobby. And if it's a hobby, your losses are going to be limited to the amount of the revenue in any particular period. And note, here's your standard deduction. You get an additional standard deduction because you have someone who's 65 or older, either the taxpayer and or a spouse, or if they're blind. One of the tax strategies they talk about is bunching itemized deductions, you know, instead of spreading them out over several years. Let's say you need a pretty major surgery and, you know, something else occurs. A pretty large casualty that is in excess of the $100 limitation and the 10% on top of that. I mean, you could, if planned well, try to bunch, meaning incur all these itemized deductions in a particular year rather than spreading it out over several years where it may not be either deductible or not as deductible. So just something to think about, but it's certainly possible to do so if you plan ahead. And then on top of the standard deduction, the greater of standard deduction or itemized, you get your personal exemption, one for the taxpayer of $4,000, one for the spouse, if so, $4,000, and one for each qualifying dependent. And notice that there's a phase out for high income individuals, as there are with a lot of these things.